Inheritance tax on death in the UK is sat at a massive 40%. So 40% of the estate, the value of assets that the deceased owns, 40% of that value is subject to inheritance tax on death, payable to HMRC within 6 months. In this video, I will outline for you 4 strategies or 4 ways we can look at to reduce your inheritance tax bill, and I will mention other angles, so 4 ways we'll look at in a bit more detail, but then there are wider strategies that we explore for our clients, which I'll touch upon as well. Before we go on, don't forget to like, comment, share and subscribe to my channel. My name is Omar and I am the owner, founder of Aswat, a specialist UK and international tax advisory firm. The first way to reduce your inheritance tax bill is via the spousal exemption. So keep in mind the spousal exemption. And this is broadly whereby any assets that are left to the remaining spouse, okay, to the living spouse, any assets that are, so if it's to the husband or to the wife, any assets that are left to the spouse are completely free from inheritance tax. Okay, so spousal exemption, any assets left to the spouse, completely free from inheritance tax. 2 things you need to keep in mind. Number 1 is that obviously once you leave all your assets to your spouse, then that spouse, provided he or she does not remarry, will have an inheritance tax problem that needs to be, mitigated and or eliminated. And the second point would be around non-domiciled individuals. Now, domicile, non-domicile, that's a different area. We're not going to go into that, but just keep in mind that for non-domiciled individuals, this spousal exemption is restricted to 325,000 currently, which is the nil rate band. Just a side point, the nil rate band has been the same since 2009. I'm recording this September 2024. So it's been the same for over 12 years and they're looking to freeze this nil rate band up until 2028. So it's not ideal for the taxpayer. Broadly speaking, property prices have increased, inflation and the rest of it. Point number 1 would be the spousal exemption. Aside from transferring assets to the spouse, so this is point number 2, any transfer of assets to any other individual, so usually it would be family members, so the son, the daughter, the grandchildren, or friends, so any individual, but obviously, from a real life perspective, the transfer is usually what we see is to the family members, will be exempt from inheritance tax, provided that the transferor, the one that is transferring the asset, survives for 7 years from the date of the gift. So for example, today, 8th September 2024, if I gifted a property, let's just use the example of a property. If I gifted a property today to my daughter, provided I survive 7 years from today, that the value of that property is then outside of my estate for 7 years. So this is why I always bang on. I always say that inheritance tax planning needs to be undertaken sooner rather than later. This is a key method that we can look to use, which is something known as a potentially exempt transfer. That's the technical term, but we need 7 years, right? After 3 years, there is something known as taper relief. So if you die between 3 and 7 years, then the amount of inheritance tax on the value of that asset reduces over the years. But 7 years, completely out of one's estate. Now, another side point here, and I'm giving you free advice, I'm giving you ideas to think about, would be that capital gains tax must be considered. So, you're transferring assets. So inheritance tax we find, but then capital gains tax is usually the stumbling block. And what we do for clients is we crunch the numbers. A lot of the time it's about crunching numbers, especially when you're looking at property. Because then there's also stamp duty, land tax, right? There's stamp duty, land tax, there's the mortgage position, capital gains tax and inheritance tax. So by crunching the numbers, we can sort of then decide exactly what needs to be done. And that's where, as chartered tax advisors, that's our expertise. Point number 3 is assets transferred into a trust. So the point number 2 was a gift of asset to individuals. This is a gift of asset or transfer of asset into a trust. Usually what we see, discretionary trusts and interest in possession trust, but there are many different types of trusts. But again, the issue here is that we have the 7-year clock. So as long as one survives more than 7 years following the date of the transfer into trust, which is known as a chargeable lifetime transfer, that's the technical term. So we had potentially exempt transfer, and now we have chargeable lifetime transfer, then we're fine. Again, capital gains tax needs to be considered. We do have the nil rate band. A chargeable lifetime transfer works differently to a potentially exempt transfer, whereby only up until the nil rate band is there no inheritance tax. Anything in excess of the nil rate band would be subject to lifetime inheritance tax. Did you know that? Did you know that there is lifetime tax, or there is a lifetime charge when it comes to UK inheritance tax? I'm not sure you did. So therefore, I'm telling you, 20% is subject in lifetime. And therefore, we have to, utilize the nil rate band accordingly. The other point around the assets into a trust would be that capital gains tax, again, needs to be considered. Again, there are ways we can work around this. Point number 4, assets left to charity. So cash, shares, whatever is left to charity. Cash is what we usually see in practice, but we've seen shares as well and property. But assets left to charity are completely exempt. It makes sense. If HMRC were looking to charge 40% on that as well, it'd be a disaster. We're already in a disaster. As of now, we're already in a disaster. For example, the transfers into trust, the budget on 30th October to be delivered by Rachel Reeves of the Labour Party. It's not looking too good when it comes to capital gains tax and inheritance tax. But as I say, assets left to charity are exempt. And then there's a side point that I want to make there, which is that if assets left to charity are more than 10% of the individual's estate meaning all the assets that the individual owns less the liabilities, then you have a reduced IHT rate, and I mentioned at the start, 40% on death. This is reduced down to 36%. So those are 4 ways for you to consider in reducing your inheritance tax bill. IHT is becoming a problem, a severe problem, and there's a few comments that I want to make here, and I will go into some other strategies that we can explore. But a lot of people leave inheritance tax planning till it's too late. The sooner the better. Some, they just don't like talking about death, which is, fair enough, that's a personal angle. And then the other is, when it comes to money and family, sometimes they can get a bit sticky, and we completely understand. We've seen many different families, many different cases. What I would say is that planning must be undertaken. Yes, there are fees that need to be paid. So our fees or any advisor's fees, for the advisory, but then also maybe for the implementation, depending what we look at. For example, a discretionary trust. But the savings in the long run. For example, a case just a few days ago, the son instructed us for the mother's estate. Our calculations, without any tax planning, would have given an inheritance tax liability of £534,119 without any tax planning. We've devised a strategy, and no word of a lie, you can believe me or not, but the tax liability following our advice, so if the client's mother takes the advice, following our planning, she will only be paying 22,000 and something in capital gains tax. So not even inheritance tax, capital gains tax. And sometimes, it's just a balance. But, that's over £500,000 in tax savings. Our fee was in the region of £10,000. But, it's up to you. It's one of them things, which is, go with the flow, pay the tax liability, pay the tax man, that's completely fine. But we've also seen instances, and I've started to notice that the younger generation, as in the children, are starting to be a bit more proactive, because they realize that, okay, my parents own these assets. Okay, my father or my mother, for example, she owns these assets. If she were to pass away, yes, those assets will inherit as siblings, fine, but we'll also have to cough up, £500,000 of inheritance tax liability, or £1 million. They realize that now. So I've noticed that the younger generation are starting to take some steps, and they're willing to pay the fees because they know that it's them that are going to be affected. As I say, in terms of worst case scenario, we've seen instances where client came to us, his father had a large estate, IHT liability, I think we did some initial calculations, about 1.3 million. They didn't take action with us. A year later, father passed away, son is calling me and asking what should we do. Well, there is one thing we looked at, which is a deed of variation, but not much came from it. There is a large inheritance tax liability that needs to be paid. And what do they need to do now? They need to sell one of their properties. Okay, they'll sell one of their properties, fine, they've got the assets. But now selling the property, okay, you're reducing your portfolio, but then there's also capital gains tax. This is what people are not realizing. Obviously, it's one of them ones where capital gains tax has to be considered as well. What's the increase in value? But there's capital gains tax. There's other angles as well. For example, okay, you need to fire sale the property. Why? Because the inheritance tax needs to be paid within 6 months. So it's better sooner rather than later. Professional advice must be undertaken. We are experts in this area. I've been looking at inheritance tax for so many years now. Some wider planning strategies would be pension funds. Pension funds can work quite well, whether it's UK pension funds or offshore. Annuities. We have family investment companies, which you may or may not have heard of. Family investment companies effectively assist with inheritance tax planning in lifetime, as well as on death potentially, and other aspects. So we have to, it's a very bespoke service. No individual is alike, no family is the same. There are always nuances that we need to navigate, and our commercial awareness and technical expertise allows you to be in safe hands. Genuinely on your side, genuinely here to help. Some of the white paper policies that have been thrown out there in terms of the budget that's upcoming is detrimental to high net worth individuals, business owners, property landlords. So we're on your side. We're more than happy to help, work closely with you, your family, and ultimately help you in achieving your objectives. That's the first thing, but in a tax efficient manner. So achieving your objectives in a tax efficient manner. So not everything is driven by tax. It's more about, okay, what are your objectives and how can we achieve them in a tax efficient manner with the tax leakage. I hope you found that beneficial. I hope you found that useful. 4 ways to reduce your inheritance tax bill, which we discussed. Number 1 is the spousal exemption. Number 2 is any gifts, so potentially exempt transfers, you have to survive 7 years. Number 3 is transfers into a trust, a chargeable lifetime transfer. And number 4 was assets left to charity. Don't forget to like, comment, share and subscribe, and we shall see you on the next one.